This strategy can be very easy for you because we are trading the market with the best trading wave indicators, swallow the market fluctuations with these two indicators, technical analysis training, and receiving digital currency trade signals with moving average. The first result of using MA in the topic of technical analysis training is trend identification. Trend traders generally buy and accumulate the desired cryptocurrency by touching certain moving averages by the price. Special means the indicator that has the most data in it. For example, 100 MA or 200 MA, which often rarely touches their price. Two signal models are received from this indicator: dynamic or moving support and resistance. When the price reaches these lines, it is generally expected to react to this line. Using two moving average indicators simultaneously and using their intersection as a buy or sell signal, trend detection. Using the moving average to confirm the price trend is one of the more basic uses of this indicator. In this case, moving averages consider the entire range of past events by reporting what has happened. This is what makes MA a good technical analysis indicator for trend confirmation. Since a large amount of data is used in the calculation of the long-term MA, a large amount of movement in the market is also needed to change the direction of this indicator. Long-term moving average is not so sensitive to rapid price changes in terms of the overall trend. Thank you for liking the video. Let's go to the most important strategy from which you can learn a lot: support and resistance. Another relatively basic application of moving origin is identifying support and resistance areas. In general, moving averages can play the role of support in an uptrend and resistance in a downtrend. Although this works on shorter time frames, e.g. 20 days or less, the support and resistance created by moving averages can even show themselves over longer periods. Trading strategy. 1. Crossover types. Crossover is the first and foremost strategy when working with moving averages. The first type of this approach is called price intersection, which signals a trend change when the price crosses above or below a moving average. Another strategy is to apply two moving average indicators, one short and the other long, on the chart. A buy signal is issued when the shorter MA crosses above the longer MA. This event is called golden cross or golden cross. On the other hand, the crossing of the shorter MA to the bottom of the longer MA means a sell signal, which is called a death cross. Trading strategy. 3. Moving average ribbon. The moving origin. Ribbon approach can be used to create a basic strategy based on slow trend changes. This method is used for both ascending and descending trends. The construction of moving average ribbons originates from the idea that having multiple MAs on a chart will perform better. This ribbon is obtained by a sequence of 8 to 15 exponential moving averages, including long-term and short-term averages, all plotted on a single chart. The final ribbon of these averages indicates both the direction of the trend and its strength. Now, the steeper the slope of these moving averages and the greater the distance between them, the wider the ribbon, which means there is a strong trend. The traditional buy or sell signals from the moving ribbon strategy are the same type of crossover signals used in MA strategies. In this case, there are also multiple intersections, so you decide whether the signal from the number of intersections is good or bad. But it is not bad to try this strategy. Put EMA 50 on the chart from the settings, then put RSA stochastic on the chart and pay close attention to the current trend. Fully supported, and without understanding the safe, without limits, you are trading. You must be careful of the level that has not been used. If it has been used, it can easily keep us down. But it is a formula that we must know that when you have a level of liquidity. Do not miss the result. It can be very valid, but if you miss it, it can be back and forth movements or even stop and liquidate, but it should not be. But in some events, when you hit, it goes towards your prediction. This is because the pressure has increased from all sides, and according to the liquidity of the market, the price wants to collect liquidity both from the bottom and from the top, then it becomes a pain. The purchase transaction is such that when the price reaches an important level of support, wait until the first encounter. After that, we enter the second collision or correction, and whenever we break the blue line and the red line in the area of 20 or 15 or even 10, and take the EMA when the price breaks from the EMA itself. And that's it. Thank you for watching the video so far. I hope you can make the most of it. Watch the video related to the strategy.